We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is episode number 108 of the Finances podcast. Our guest today, Damian McIntyre, CEO at GSF Funds Management, and attending with Damian today, Simon Newman, a key account manager for Vic and Taz at GSFM. Thank you, Damian and Simone, for joining us on our little podcast here in Geelong West. It's sunny Geelong West today. Thanks for coming down.
Oh, thank you for having us.
Now, we always make the mistake of talking almost way too much before we hit record. And as we were just talking, Damian, within a couple of minutes, we know 3 or 4 people. The connections in Geelong are ridiculous. But we end up talking about things that we really want to touch on in the podcast. Simone, when we talked about getting you guys on, one of the things that we thought would be really interesting to touch on, because it's probably something that Ben and I are super curious about as well, is the formation, the foundation, the sort of origin story of GSFM. So we'll get to that. But can I just firstly just get a little bit of an introduction from yourself, Simone? Maybe just give us a little bit of your background, and then we'll jump over to Damian, who will do the same.
Sure, Jay. Well, thanks for having us on board with your podcast, which is getting quite an audience. A couple of meetings that we just had prior to this, everyone seems to know about the Burke Britton podcast.
Make sure you clip that then.
You're doing well.
Keep us going. I always say any bit of positive feedback gives us another few episodes.
It does.
We got to 108. So
I think most people don't. Someone told me, we had a young guest on one time, and he said that 90% of podcasts don't go beyond 5 episodes. So, you know, we're winning.
You are definitely
The content's terrible, but we're winning. We're still right. Sorry, Simone.
No problems. So, Jay, I have been with GSFM Funds Management for just over 2 years. And prior to that, I had actually close to 20 years in the funds management industry across different areas, being marketing, product management, distribution. So it's been quite a good couple of decades. I've seen some interesting cycles throughout that time, and absolutely thrilled to have joined GSFM Business just over 2 years ago.
Beautiful. Do you ever get sick of giving the planners a hard time to try and catch up with them and get a half an hour of their time?
Oh my goodness.
Do you get past Teresa at reception or Amy at practice management?
Those receptionists, they are hard work. To get through those gatekeepers, whew.
Listen, hats off to you, because there's a cycle, as you well know, there's a cycle of fundies that want to spend time with the planners, but those that actually make it through, that we have great relationship. It's awesome to have you here and have had the relationship we've had with you, and hopefully we will continue to have. So thanks again, Simone. Righto, Damian, let's tell us a bit about yourself, and maybe you go back as far as you like. I know we went back we're talking Horsham and football and the Pies and in the 70s and 80s. You can go back as far as you like. Where did you grow up? Where did you school? And ultimately, how did we end up with you being CEO of GSFM?
Okay, born in Sydney. So my mum and dad are, I can loosely refer to them as 10-pound poms. They came out from Ireland in the 50s, and the family originally settled in Sydney. So born in Bondi Junction. And I think what happened when I was 4 or 5, my father had an opportunity to buy a business in Melbourne. So the family migrated from Sydney to Melbourne, and I've lived in Melbourne for, the majority of my life. I did have another 5-year stint in Sydney when we set up GSFM from 2007. But yeah, born Sydney and raised in Melbourne.
What was your dad's business?
He was a publican. So he ran pubs, owned pubs and ran pubs.
They still in existence, some of those pubs?
Yeah, all the pubs are still. Not all of them are. Some of them have been developed into residential developments because of the land footprint. But most of the pubs still go. So Dad was, a working class guy, and he liked to drink. And I think that his occupation certainly, it played to his strengths. He was the old school publican of being on the other side of the bar, shaking hands and slapping back. So he certainly enjoyed that aspect of his work. But, all good things come to an end. And my oldest brother was the last of the family who's still involved in the pubs. But he's been out of it 10 years now.
You had no interest in getting into the publican game?
No, largely because, we used to refer to it as prison camp, because as soon as the holidays started, the old man had you in the bottle shop from 10 a.m. to 10 p.m. So, they'd bring out a plate at lunchtime from the kitchen and...
leftovers?
Yeah, but you were basically doing 12 hours on your feet. So, no, I didn't like that aspect of the game at all. And so, the old man made the most of having 6 kids, put it that way.
Do you think you learn a lot out of it, like as a kid working in that environment, or not really? Did you?
Oh, absolutely. I think you meet a broad cross-section of society, that's for sure. And Dad was very hard. Dad was an old-school publican in the sense that his view was these people aren't your friends. He used to say, look, son, I'm in the beer business. I sell beer. So the sooner they get a drink in their hand, the sooner they're back for another one. So I don't want you talking to them, I don't want you wasting their time. I want you got a job to do, and that's it. And that was so he ran the place with an iron fist, and it operated quite effectively. But certainly, as I said, you met a broad cross-section of society, from people who spent too much in the bar to those who used it as a social outlet and were less prevalent, if you like.
I find it interesting when anyone who we've had where they've dealt, again, dealing with people, and I would think about myself, I worked in a server on the same thing where you just deal with all walks of life, basically, probably similar in the pub industry. So you learn how to converse with all sorts of different people really quickly, especially if you're a kid.
Yeah, that's right. And you also learn to be respectful and you know your place. So no, I think it was an invaluable experience.
At what point did you think, no, this is not for me, and go off on another tangent away from the family business?
Well, when I finished year 12, a mate of mine was working for a stockbroker in the city, and he was a messenger. And he just basically said, this is the greatest lurk of all time. They go to the pub at lunchtime, you go to the pub after work, there's girls everywhere, blokes everywhere, it's a lot of fun.
Yeah,
and, and you're paid $150 a week. And I thought, geez, how do I get into that? So that's how my career in financial services started.
So how old were you then?
I was just turned 18.
Okay.
I was 18 in a month. That's when my career in the family business finished.
So I heard in one of the podcasts that I listened to with you recently, and you said that you were working on the floor at the stock exchange. Did that come out? Did you go to uni, or did you go straight out of high school and straight work for a broker? What did you do?
I studied part-time.
Yep.
So I promised my mother that I would go to university. That was the whole point of an education. So I did it the hard way. I studied part-time and worked, during the day, which was also teaches you to be disciplined. There's a time for work and a time for play, and if you overcorrect the wrong way, or if you go the wrong way, you're behind, and then you got to catch up. And
did you always have that discipline, or was it because you were motivated with the broking, or was it sort of the influence of your dad and the iron fist?
Well, I think with most young blokes, discipline comes in fits and starts. The more you learn, the more disciplined you become, I suppose. And, I'm a social person and, I had my distractions. But for the most part, the good thing about studying uni at part-time, it started in, late February, early March, and it was done by the end of October. So really, you
summers of your own.
Yeah, that's right. You had 4 months off, and you really only had to be disciplined for 7 or 8 months of the year. So I learnt to get the rhythm right.
So what exactly did you study, and what were you working in between? What were you doing work-wise?
I studied accounting,
or
a Bachelor of Business with a major in accounting. And then working, I started off as a messenger. And then it was just a complete fluke how I ended up on the floor. Was there were phone clerks and operators and market makers, and 2 guys who were very good friends who both worked on the floor. They came back from their Christmas holidays and they basically said, well, we're quitting, we're going to another broking firm. So we were 2 guys short on the floor, and literally one of the operators, I was basically in the mail room sorting envelopes, and I got sort of pulled by the collar, you're coming with us. And I went down to the floor that day. I had no idea what I was doing, but they liked me, and I ended up staying there.
So what did a day on the floor look like? Or what were you actually doing?
Well, it was quite primitive. Well, in those days, none of it was...
So just to give some context, what sort of...
1984.
1984,
This was January of 1984. So I was literally only with Bain & Co. a month or so before I ended up on the floor. And it was all manual back in those. So literally, the phone would ring from private client desks or the institutional desks up in the office to the floor. There was a bank of, say, 4 or 5 phones. You'd take a call. It would be either a private client advisor or an insto advisor saying, I need you to buy or sell this stock. You wrote it down on a slip, which was in triplicate. You handed the slip to the market maker or what was known as the operator who covered those stocks. He would then, or she would then, walk over to someone who worked for another firm and basically say, I'm in the market for 10,000 BHP, for example. And that's literally how it was done.
Wow, it's fascinating. As much as I sort of understood a little bit to hear, it's not that long ago.
No, it's not. No, it's not.
That's what I always think. It was come so far.
Yeah. It was so analog. And it was all relationships. So part of the skill was to understand which brokers were active in which stock and who you could approach to get a line of shares either bought or sold. And yeah, it was a relationships business even to that extent. And then once you'd agreed on a line of share on a line, you would then go up to the chalkies, who were the guys standing. I don't know if you remember seeing photos of these guys or vision of
movies.
Yeah, well, they basically they stood along the walls and they had chalk boards, and you would basically say to the chalky, I've exchanged X security at this price and this volume, and then you would give them one of the three bits of paper, which was, so one was your record, one was the other side, and one went to the ASX. And it was so analog.
I was just getting my head around how this would all flow through. You think about it now, we get so hung up on data and details not being there immediately. I think the processing time on that stuff must have been enormous.
What the godsend for me personally out of all this, the way it was all recorded was that every day a broker would receive these tiny sticky lines of paper. There was reams of them for every client and every line of stock. And you would have to take it off unravel it, and then you would stick it to a piece of cardboard, which was the client's record. So I was terrible at this. I tore them. I
Spilt coffee.
Yeah. No time for coffee.
So it was I was very lucky I dodged that part of my career. I reckon if I'd ended up being a script clerk, which was the next progression from being a messenger to the script clerk to the floor, I would never have made it to the floor. I wouldn't have got past being a scrippy. But I was very lucky.
This might be a really stupid question, but does the floor still exist in any way, shape or form today?
No, not in Australia.
No.
The only place that it exists is in the US.
Yep.
Still see the odd, news cross of that, don't you? They love that imagery of the floor.
Ringing the bell.
Yeah.
Yeah, well, we're all really scared about, if you think about, back then and when we went to seats trading or the electronic trading in the early 90s, a lot of people lost jobs initially, and it was quite confronting a lot of people who were out of work. But eventually, the sell side, which is the brokers, and the buy side, which are the fund managers, as the funds management industry grew, if you had any experience as an operator or a dealer, you ended up working for a fund manager as a dealer. So it took time for everyone to be absorbed back into the game, but eventually everyone found jobs again,
So what happens after that? So you found yourself on the floor. How long are you in that gig for?
I was there until 3 or 4 days after the great stock market crash of 1987 occurred in the US on the Friday night, and then our markets opened on the Monday, and it was pretty black on the Monday. And then I was made redundant on the Thursday, 4 days later. And broking back then and indeed today is a highly transactional business. And when the volumes are there, you've got big staff. And when the volumes aren't, they cut them and they're ruthless. And it's the law of the jungle. Yep. So I found myself without a job, and I was really lucky. A fellow I played football for, who coached me, offered me a job in an accounting firm in Albert Park, and they had a securities license or a dealer's license. And I had a brief career in audit, which was much like my career as a script clerk. I probably wasn't the best auditor. So I was lifted out of there into the financial planning and investment arm. And I worked there for 3 or 4 years. But I was a kid. I was 22 years old. I was a kid. I had a good understanding of markets and securities, but life was a different proposition. And so I worked there until 1993, and then I went to work for a firm called Potter Warburg Asset Management. And I always wanted to go back to the markets because I enjoyed the intellectual stimulation of financial markets. That was the adrenaline of, and also the fact that every week and month is different. So I wanted to get back there, but I didn't want to go and work for a broker because you're expendable. At least working for a fund manager, you can see it coming by the success or lack of the organisation you work for. So I bided my time and I chose to go and work for Potters, and that was the beginning of my career, and which I'm still doing today.
Was that the traditional pathway? Like, was that what most people wanting to do, or was yours a little bit, is it always a bit different? It was not really a traditional pathway.
Well, I think if I'd had my time again, I wouldn't change anything that I've done. But I suppose the one regret I have in my career is that I never managed money. I'm very good at articulating an investment idea, and I can sell. So I'm quite good at that aspect of the business, and it's an important aspect of the business. But if I'd taken a different route, I would have not gone to uni part-time. I would have gone to uni full-time and then got into a graduate trainee program and hopefully ended up as an analyst and then, progressed to becoming a fund manager. I mean,
I half assume that might have been what the general pathway is through that analyst path. So you skip to that bit.
Yeah, that's where you start.
Yeah, you sort of jumped around that a little bit.
Yeah, so I think, that is the regret of my career, that I never managed money. I've only talked about how to manage money, so anyway. But that said, I'm very happy with my lot in life,
So through the 90s, you were working with, you said Potter for 3 years. Or was it more? How long were you there for through the...
I was there quite a while. Potter Warburg became Mercury Asset Management by acquisition in 1995. And then in 1998, Mercury Asset Management became Merrill Lynch Investment Advisors, or Investment Managers, I should say. And I was with Merrill until I left the firm in 2006 and then started GSFM with Andrew in 2007. So I was there for 12 years, 13 years.
Your role at Merrill, what were you doing there? What exactly?
Started off as a business development manager, so much like Simone, and Geelong was part of my patch. So yeah, really just talking to financial planners about our funds and trying to raise assets from, a client base in Victoria and Tasmania. And then I was, lucky enough I was good at that, but I'm also lucky in that I can take people with me. So I was promoted to a national sales role in 1997. So I looked after a team of BDMs, but also the strategy of the retail business for Mercury and then Merrill. And then I ended up being promoted to head of distribution. So I ran retail sales and institutional sales. So, effectively, I was in charge of the firm's revenue line. And I was on the executive committee both of Malim as well as Merrill Lynch in Australia. So that included the broking and investment banking activities as well. And yes, I did that until 2006 and took some time off and then started GSFM with Andrew in 2007.
How was the timing with that? So starting 2007, there's a bit going on, 2007, 2008. Maybe give some context. We haven't given a shout out to your family, your wife, but you were, I'm assuming you had a growing family at that point. How old were the kids around 2007?
Yeah, so we had 4 kids under 7.
Yep.
And look, I'm incredibly fortunate. My wife has always been highly supportive of me and my career. She was also a BDM. She worked for BGI, or Barclays Global Investors as they were back then, which ended up being bought by BlackRock.
Did you meet at a conference or something like that? Is it a true life story?
Yeah. No, well, funnily enough, we did meet at a conference, but I met her. Conference was after the 1995 grand final, and she's a Carlton supporter, and she was, let's just say, enjoying win. So I sort of thought, I don't really want to listen to someone Carlton supporter carry on for. So I wasn't the attraction wasn't instant.
Sounds like a bit of a turn off to me.
But we grew on each other over time. So that's sort of how it happened. But but when we started GSFM and the whole crisis thing, it was confronting in the sense that I left secure employment, I was on the Exco, so I was sort of up at the top of the firm, and you have an income and a lifestyle, and then you become an entrepreneur. And, I won't say I hadn't hopefully thought that through, but you expect to succeed. You don't go into things thinking you're going to fail. Then the crisis was really rugged. We didn't generate any revenue until December of 2008. So for the first 3 or 4 years, you're using your house as an ATM to support the family. But, I kept selling it to myself as much as I was selling it to Kate, that we'll work out in the end and the good guys win. And lucky and fortunately, we did,
Yeah, it's maybe going a little bit granular on that decision to move from Merrill to your own shop and even GSFM, which was Grant Samuels. What was the origin of that? What partnerships are involved in actually the establishment of the business in its first instance? Who was involved? Yourself? Was it just yourself, or who else was?
No, Andrew McKinnon, who's our executive chairman and he was the original CEO of GSFM, he and I and a secretary started the business in partnership with Grant Samuel in 2007. Grant Samuel were a corporate advisory and still are an independent corporate advisory firm, and they were really attracted to funds management and the annuity style of income as opposed to transactions. And Andrew had a relationship with one of the most senior people there, and it was Andrew's introduction to GS that got it going. Andrew established Credit Suisse Asset Management in Australia, and they were really big competitors of Mercury and Merrill. So I would see Andrew in the marketplace all the time. We'd be going to the same beauty parades for mandates on the institutional side. So I sort of got to know Andrew and developed we're never friends, but we had a mutual professional respect of one another. And it just so happened that he left Credit Suisse around about the same time that I left Merrill, and we were both on garden leave for a period of time. And by fluke, we came together, had a conversation, and I really admired and respected Andrew. And Grant Samuel weren't an investment bank. I think if we'd floated this idea to a bank, it wouldn't have survived through the crisis.
So you left your other job not without that already organised with Andrew?
Correct, that's right.
Gotcha. I was sort of under.
Yeah. No. I was just sort of.
You just needed a break.
Yeah, I needed a break.
Yeah.
We had 4 little kids, and you at that stage I was reporting to a guy in New York and London, and you're just on the milk run every quarter to manage up. So I just needed a break, and I was lucky enough that my contract allowed an extended break, what we call garden leave. So, and then it was through that I was actually doing some consulting work for Mirvac, and I happened to be in Sydney where Andrew was living, and that's how I met Andrew, as he was putting together his cunning plan to start the GSFM.
Amazing, by chance, really.
Yeah, it sounds like a lot of your life has happened by accident, Damian.
I'm
right?
just lucky.
Yeah, just lucky.
Yeah.
No good management, just good luck.
I think you got to make the most of your opportunities when you get them, but I definitely think I'm born under a lucky star. I don't kid myself otherwise,
What were some of the biggest challenges? The reason I ask this is that around that time, 2008, I was saying to Ben earlier on that we bought a business in Shepparton. We bought a business called Secure Life, and obviously it was at the peak of markets, and it's about, we paid full tote odds for a business that was largely a trail revenue business, only to within sort of 9 months see that revenue disappear by 50%. It was a challenging time, and again at a scale that was probably nothing to the degree that you were talking about. But what were some of the maybe obvious or not so obvious challenges that you were presented with during that period of time?
Well, I think the first thing is we had nothing. This was literally, we got our license.
Yeah. So at least I had some revenue, you had none.
Yeah, we had none. Yeah.
Okay. And no clients. It's a good start.
It was. But the really interesting thing about all this is that, so if you go back to that 07-08 period, again, we're very fortunate that Andrew had a relationship with Bill Priest and Epoch. So they were our first partner. They didn't have a client in Australia. They hadn't. So if you think about it in the context of markets were horrible during the crisis, and a lot of fund managers underperformed, and some of the underperformance created real problems for clients. So we had none of that baggage. We'd never lost anyone any money. We'd never underperformed. So you had to choose your moment of when you sort of presented this new idea, but we had no baggage. So even though we were 61 months before we had a month where revenue was greater than expense. So that 61 months is a long time. That was the opportunity. is that we had no baggage. It was a brand new idea. And if we were good enough to get people to come with us.
And so anything coming in would have done pretty well.
Yeah.
Because it was starting from such a low base.
Yeah.
Anything you can, you just had to ride that.
Yeah, that's right. So fortunately, again, like we chose the right partner at the right time who had a great idea. And, you know, Andrew and I collectively were successful in commercialising it. And Epic or Epoch, you know, really put us on the map and, you know, allowed the firm to thrive and grow, you know.
We were debating that earlier, how you say it.
Yeah, I asked Damian that. So it's the Canadians and the Americans, it's Epic, but for us, it's Epoch. I think in a couple of podcasts, you swapped between. I thought, am I missing something here? But Epoch for us, but Epic for the North America. Ben, this is where I lose my train of thought and you're supposed to jump in.
I suppose what happened, Ian, that you really getting those wheels in motion from ground zero. How does the business grow from there? Like, what's the next big sort of step after Epoch? Like, what happens from there?
Well, we added more managers. So in May of 2008, we purchased a shareholding in Tribeca Investment Partners, who were Australian equities. And then, so we had two stories to tell. Fortunately, Tribeca had a good reputation and they had a very good long-short fund, which we were, again, able to successfully commercialise institutionally and in retail. And then in 2010, we signed Payden and Regal. So we had global equities through Epoch, domestic equities through Tribeca, and global fixed income through Payden. Again, but fortunate in the sense that both for Epoch and for Payden and Regal, we were able to win an institutional mandate within 18 months of starting the relationship. And the retail market follows the institutional market. You know, the retail market looks to the institutional market for validation. So if you can win money in the institutional market out here, you've got something. So again, we chose well, our timing was right, and that was the platform to give us 3 revenue lines, if you like.
Was the strategy to keep adding alternative sectors? Like, was that or investment options? Was that the goal from the outset, or was it sort of a natural flow?
It was a natural flow. So I talk about 61 months before we had a month where rev was greater than expense. We bootstrapped the business from the 3 of us to month 61. I think we had 17 employees at that stage. And so we added more bandwidth to our distribution capabilities, which allows you to talk to more people and raise more assets. So everything you add is really only a function of what you can service, particularly as you're growing.
Yep.
Institutional is not so bad because, you know, there's not as many clients, but retail is thousands. So, you know, we had to be careful in how we scaled up. But I think the other thing that we were very conscious of, and this is part of the business today, is that we don't compete with ourselves in asset classes. So we don't have 2 global value managers like Epic or 2 Australian equity managers. You know, we feel that it's hard enough to get your attention to talk about one manager. So if I turn up today talking about Epic and then tomorrow I'm going to turn up talking about another global value manager, it's disingenuous. And you're thinking, well, what are you going to sell me now? And so too are the fund managers. They're thinking, well, when are you going to, you know, how do I get my fair slice of your time and effort?
That's why I asked it, because you can clearly see when you roll through and look at all the different managers, they're all very different.
Yeah, that's right. That's right.
So that's a purpose-built feature.
Yeah, precisely. We just didn't want the commercial buzzwords with channel conflict. We didn't want channel conflict. It's largely, as I said, in our own view, is that it's disingenuous to try and sell the same thing twice, which is the practical reason and the ethical reason why you don't do it.
Perfect.
There's obviously some challenges in that, though. The fact that you potentially have to spread yourself across a multitude of different industry sectors and styles. Does that present more challenges than than maybe you envisaged when you decided to go down that path?
I think it does, and how you address the challenges, it is all about who you hire or who is on the team. So you want people, first and foremost, you want people who understand an investment concept and then can articulate that investment concept to an end client. Now, that whether that's a financial planner or whether that's an investor or an institutional client. So your starting point is always who you surround yourself with. And I don't want this to sound too folksy, but you know, once upon a time I used to hire the smartest people I could, and I just hoped they were good people. Now I hire the best eggs I can, and I just hope they're smart. That's a little bit flippant, but if you hire people who are morally and ethically sound, they're going to give you 40 hours a week that you don't even have to think about. You know their effort's there consistently. You know they're not selling something to get a result for their own pay packet. You know that clients are going to be making informed decisions about the investments we're positioning with them. And then the clients are on the book for longer, and it's just a better book.
There's just no surprises for anyone.
No, that's right. So
Do you do that on that hiring? Do you do that on instinct, or do your personality profile people that you're recruiting or employing? How do you go about that recruitment process?
it's all instinct and experience. We do a lot of reference checking, but, you know, at the same time, you only learn by making a lot of mistakes.
Yeah.
So it's just, you get a feel for someone. I suppose these days my radar for what I want or who's going to fit is
Pretty highly tuned.
Yeah, that's right. That's right.
It's all those days behind the jump at the pub. You've been able to...
Well, that was the starting.
Yeah, for sure.
That's right.
Now, I'm mindful of time and we don't want to keep you here forever, but I thought we might potentially take a little bit of a track into the markets. Our client will want to probably, get a little bit of a gauge on thoughts on the market and where it's at. And I thought it might be worth just reflecting on a couple of your podcasts that I listened to in the last couple of weeks. You did one at the start of the year with Stephen Miller, and you were just talking about sort of the macro and structural outlook for 2024. And that was, I think it was in February or March that you actually, it might have been January that you recorded that. I thought it might be worth just asking, what do you think you've actually got right, looking, and if you can remember that podcast, what you anticipated 2024 might look like, and has anything surprised you? And again, you can answer that in whatever context you like across any of the funds that you've got, but is there anything that surprised you now that we're more than halfway through the year? How do you view the year, having looked back to what you spoke about in January?
Well, I think let's start with interest rates and inflation. Interest rates, there is a high level of expectation that interest rates will fall and fall rapidly. And I think that's as much hope to some extent. We all want them to come down. But I think central banks have led with their chins, and they've been too dovish. The dovish meaning they're leading with their chins is the right way to describe it. They've created an expectation that if this set of circumstances presents itself, that presents an opportunity for interest rates to fall. And I don't think what people have anticipated was how long inflation would last and how sticky it's been and how hard it's been to shake it off. And inflation is omnipresent. It's in all aspects of life, both consumables and services. So I think inflation has persisted at higher levels for much longer than anyone had hoped for, let alone anticipated. And that's really made it hard for central banks to ease monetary policy. But I want to make one other point. If we go back to the financial crisis, where effectively the banking system was broken and commerce and society can't function without a functioning banking system. So what occurred in the United States in terms of bailing them out was absolutely necessary, because the world would never have recovered if the banking system didn't work. Now, we can all debate the ethics of and whether or not these guys got out scot-free. It doesn't matter, because the big picture is that we need the banks. And fortunately in Australia, the banks have always been, well managed and, they're intact. So what that led was interest rates to go to zero, and in some cases, in some geographies, interest rates were negative. So if you think about it, that is the most elaborate economic experiment that we will have seen in our lifetime. I can't imagine something more bold than that set of circumstances. And even the thought of having to pay someone to accept my deposit, that is just, it's weird.
Yeah.
So this experiment, I liken it to, this is a crude analogy, but I liken it to methadone. And this zero interest rates policy or low interest rates policy was methadone. And when you pull the bears off the methadone, they're going to get grumpy. And really, that's what we saw in 2022. Inflation got the genie got out of the bottle, but equally, rates snapped from nothing to a big number really quickly. And then everyone's cash flows had to adjust. So depending on the industry you're in, some industries have been able to cope. They've been able to have revenue and sales growth that have kept their earnings intact, but other industries haven't. And then if you look at across the cross section of society, the same rules apply. Some people have had a financial cushion large enough to absorb their increased mortgage expenses, but there's a big swathe of society that hasn't. And where we're different to the United States, for example, is that in the United States you can fix a mortgage for 25 years. In Australia, the longest you can go is 5, and those mortgages now are rolling off. So, it hasn't been, not only has it been a long way out as far as inflation's concerned, but, people's cash flows have also been negatively impacted, in some degrees drastically, in other degrees less so. So we've had this really, coping with change has been a lot for not only financial markets, but society to deal with. And the answers aren't clear cut. And you can see that. I mean, there is an old saying that's really true, and that is that, capital always chases profit. So if you think about that in the context of the Magnificent Seven, they're the names that are exhibiting the highest growth. So that is why the capital has swamped them, and now here we are. I mean, I can remember thinking about coming up to the last quarter's earnings number. I don't know if you remember, the press was saying we're all desperately waiting to see what NVIDIA was going to do.
Bit scary.
Yeah. And I can remember sitting there, I think I was in the car, and I was thinking to myself, is this what we've become?
Yeah, we're going to hang on one stock. There it goes.
Is going to determine what happens for the rest of the year, or let alone the quarter, But so the frustrating thing about the market is that pattern of capital chasing profit, we struggle to learn from previous mistakes. So, but all that said, this is why we have a diversified book. This is why you have growth and value. Value has underperformed for a long period of time. It won't be forever. Real estate has struggled because of high interest rates. Interest rates will eventually come down. Real estate will come back. The cycle, it's just frustrating at times in the middle of it.
But it's necessary.
But it's the cleansing part of it is necessary.
We've been through probably more so, this is probably us clients sort of seeing it. It's been such a long period of low interest rates that so many people have become so entrenched in that low rate, and they've taken on more debt than they've ever seen before. When it's coming out the other side, a lot of them have never in their sort of adult life actually dealt with rates above 3.5%-4%. So they just have no capacity to see forward and think this could even happen, where really rates aren't that high. They're obviously higher than what they were, but historically they're not high.
No, that's right.
So it's just, again, there's so much learning going on in a really hard way, and people are coming in panicked, which is across the board what we're probably hearing anecdotally anyway, and that flows all the way back through, right up to the top, doesn't it?
Yeah, it does. It does. But again, fortunately, your clients will be diversified.
Yeah, it's okay for the ones who've been around for a long time. It's the people coming in when they have very limited options because they've backed themselves into a corner with usually debt. That makes it tricky. It's probably the same, but yeah, about having flexibility, diversity in your portfolios. These people in their we call it their household economy, needs to have diversity and some levers they can pull on themselves. And some people don't.
Yeah, it's one thing that also, to some extent, galls me is listening to market commentators talk about the need for pain to correct a situation. And you sort of think, hang on, guys. I mean, you're sitting there, your economic circumstances are obviously, you can withstand the pain or you can afford the pain, but the majority of people can't. So be very careful about how it's okay to think that, but you've got to be careful about how you put that. Anyway.
Maybe you mentioned a couple of things around the Magnificent Seven, which obviously gets a lot of airtime at the moment. Simone, you might have sent me this question, a pre-planned question, but it was in relation to the Magnificent Seven, when AI stocks dominating stock markets, like Epoch specifically, which has a pretty low exposure to the Magnificent Seven. How are they adding value, given that makes just such a significant part of the market at the moment?
Well, I always feel incredibly comfortable when talking about Epoch and the shareholder yield strategy when we come back to its construct. So its basic construct is that it only owns companies that return 6% of themselves to shareholders every year. Now what I mean by that is that of that 6%, 4.5% of it is a cash dividend. So that's cash in the shareholder's pocket by way of a transfer. And then the other 1.5% is buying back its stock or reducing its debt. Buying back its stock and reducing its debt both have positive impacts on earnings per share. If you're cancelling shares, there's less shares on issue. So by definition, EPS goes up. And if you're reducing debt, your interest expense declines. So EPS goes up, but so too does your cost of capital. Think of cost of capital as it's an interest rate or a margin loan. So the less you owe, the better a credit risk you are. So that's why the cost of your borrowings reduces. So I love this particular strategy because the first 6% that you earn is in those forms and they're to your benefit. And then the other thing I love about this for this particular fund is that every name that we own also has to have operating cash flow growth of 3% per annum. So they're real businesses that are increasing their revenues and operating cash flow every year. So they're not selling the furniture to pay a dividend. It's not a self-liquidating outcome. These are real businesses that make real money and they return it to shareholders. That's the thing that makes me feel really comfortable. Now, in the context of the Magnificent Seven, where they're in conflict with indexes is that they're not growing as fast as the other guys. So therefore, they don't necessarily get the love of investors. Microsoft might be growing at 25% per annum. A utility might be growing at 9%. And that's the difference in terms of price performance. It doesn't necessarily make one business any worse than the other. They just have different growth profiles. But the key is, and this is, again, why I'm always comfortable talking about it, is because I know these businesses won't blow up. They won't go broke. And furthermore, we own the other side of 100 of them in a portfolio. So we're not taking a lot of what we call stock-specific risk. With 106 names today in the portfolio, if one goes bad, there's still 105 that haven't, if that makes sense.
Yeah. I often say this to clients people will say, oh, do you ever worry about the market? Like, do you worry about what you're doing for your clients and things? And I sleep pretty well at night, but a lot of it comes back to understanding, like, inside of each of those portfolios is something, like Epoch, understanding that, how it's structured. And if we understand it and feel pretty comfortable, or very, very comfortable with it, then when you're putting it into a client portfolio, you feel equally comfortable with it, and then you don't carry that stress as the person advising on it. And I remember that presentation we were talking about earlier in Melbourne and that cash flow growth thing vividly. And in some ways, I always think of Epoch as it's a bit boring, but I like it like that. Like that's sort of just, and that's what it's meant to do. So we don't have to be too actively in there looking at it either. Like we can just sort of trust that, we've been involved for a long time. You just trust that they're doing the right thing. They stick within those mandates. I think the worst thing you can see, and you would be way more versed in this, is where people go outside that, chasing that index. Like people go away from what they actually are to try and match that index. Where you go, it's okay. The index is not really what we are. In a way, it's a terrible mechanism for tracking the performance of something.
Yeah, that's right. That's right. And look, unfortunately, you've got to be measured against something. Yeah. And the way that the industry works is that we use equity indexes as that measurement tool. And it's just not a perfect science. But again, like the index underperformance, of course, is frustrating, but I know why. And I also interact with Epic every month in evaluating what's occurred over the previous month. I know them well. I know what they're doing. And they don't style drift or they don't buy what they shouldn't be buying to get a better number, They
don't feel the pressure and start piling into NVIDIA because they think, we better try and close that gap on the index, for example. Like they'd go, it doesn't fit our mandate, doesn't fit what we're looking for. That's okay.
Yeah. And from our perspective, so long as you're making informed decisions about investing in that, as long as you understand that, well then we understand each other and we can live with it.
Yeah. And that's why back to earlier, why this relationship is so important. And something, again, you're talking about how hard it is to get in the door with advisors, but if you open the door and you understand it better, it just helps everyone.
Yeah, couldn't agree more. Maybe one last question on markets, and this is, I asked Ben this before we came in, talking about, like, particularly young people, they'll come in and, well, not necessarily just the young people, but people always have a sense that from an investment management point of view, they've been told, and it's been marketed pretty well, that index investments are the go. Just pop your funds in the index investment, whether it be in your raise account or in your super fund. What you spend your life in sort of active management of funds. What is the value if you're talking to someone about, I suppose, the positives and negatives of index investment and where active management is set apart? What would you say to them?
Well, I'd say that there's a role for both, and I'm not intending this to be a self-serving
No, it's okay.
comment. Where indexes are valuable is that they give you exposure, and it doesn't matter. I mean, you don't have to worry about style, for example, when you're buying the index, because you're buying everything. So that's the positive. You get exposure and it's cheap, and that's the role in just to give you beta, what we call market beta. That's where they're invaluable. Where I will always talk about the benefit or the value of active management is if you think about an index, what an index is it's the biggest game of survival of the fittest on the planet. So those that, like the Magnificent Seven, if they perform the best, by definition, they get all the capital. And it's just the smaller guys or the guys who don't perform basically get rinsed out. They get taken out of the index because their size or their market capitalisation has fallen. So where an active manager earns his dough is that he can look at a set of companies, or he can look at a set of, an index, and choose companies that are going to be those that he thinks will end up being the outperformers and not owning the underperformers. Does that make sense?
Yeah, it makes sense. Yeah, I'm kind of thinking about where that saturation point of, you think about all the money that flows into index investments and, the likes of NVIDIA and those companies that make up the large part of the index. Like, what's the tipping point? What's the breaking point where there is just a constant flow of funds with no active management?
Yeah. The difference is the most successful constituents in the index, or the biggest players in the index, right? They get the money because they're the biggest guys, right? Not because they're the best guys, not because the market has any great insight as to what's coming. They just get the money because they're big, right? And the little guy gets sold to make room for the big guy.
Which is kind of scary when you think about it.
Yeah.
All the money's flowing to the...
Yeah, it's narrow, right? And where I'd like to think active managers, earn our money, it's a decision. So we actually have to decide whether we believe the hype and we want to own the big guys, or, hang on a minute, there's value down here because we see a brighter future for this company in the coming quarters and its price is low.
Do you think as more money flows to the index that it makes it easier or harder for active managers?
Look, I think it makes it easier, to be honest.
So I was thinking of the structure with that flow.
Yeah, because if you think about, again, we're coming back to the construct of the industry, is that all the research efforts go to the largest names because that's what everyone wants to hold. The biggest name in the index is your biggest risk. And the bet you're taking is if I own it, well, I can't underperform that. It's a matter of how much of it you own. If you own more than the index weight, well, you're taking a bet the stock's going to outperform and that'll help you beat the index. But the decision you're making by not owning it is, I could be wrong here and this could hurt. Where I want to get to is that all the research is concentrated at the largest names in the index, and there's virtually no research at the other end of the spectrum. And that's where active managers with their teams add the value, because they're the only guys that are actually looking, asking questions, trying to find the next small company that'll become the next NVIDIA.
Yeah.
And that's what's exciting.
That's what I was thinking. If money keeps flowing that way, then everything flows that way. There's not as much time spent on these other ones, then there's more opportunities if that's where you're looking.
Yeah, that's right. And it becomes, it really, look, from a broking perspective or it's a lazy game, because all they do is concentrate their research efforts on where they can sell research. Whereas our guys, the active guys, we want to be where they ate.
Which is why it's more expensive being active, in a sense. It's more involved in it because you've got more costs, more people, more resources to go in to find, ultimately, the aim is to find more return.
Yeah, that's right. If you think about it in terms of a research budget, the investor has to pay for the research one way or the other. Now, it's either the stockbroker that provides the research and it's paid for in the brokerage that results out of that provision of service, or you're paying a fund manager and his analyst team to scour the market looking for the diamond in the rough, so to speak. But we've still got to have large teams that can cover the ground, to find those opportunities.
There is one other benefit that I would add for active managers as well, and we've kind of touched on it, but I think it's absolutely critical. As an active manager, you can create a specific strategy, which passive managers don't have the luxury of doing. They're simply just chasing the big guys. Epoch is a beautiful example of having a very specific strategy, not just chasing the big guys, but looking for those heavy cash flow, defensive, highest quality businesses that distribute yield back to shareholders. That's a very specific strategy, and they've delivered on that exactly as they've said on the tin, as they say, completely disregarding the index. But from a portfolio management perspective, which is critical for you as advisors, understanding how that strategy fits within the whole portfolio construction, yield, defensiveness, capital appreciation is vastly different to a passive.
I think that's the biggest thing for us is the yield. And again, especially a lot of retiree clients or people just seeking passive income is, through COVID, GFC, all these downturns, we know what we're going to get. It means we're not selling other assets as well. We just continue to generate income. And that's for us, again, down in that micro level, what we really value about it. What helps, again, complements the rest of our sort of strategy with the investment mix we've got.
Simone, while we're on this, maybe it might be worth, we've touched briefly on some of the funds in the portfolio. Do you maybe just want to touch on what else is in there in GSFM's portfolio of funds?
Suite of strategies,
Yep.
For sure. So we've got Epoch as our value tilt global equities fund, and at the opposite end of the global equity strategy scope is Munro Partners, and that's your high octane. That is your capital growth. It's not for those investors that are looking for income. That's where you're going to gravitate towards.
Felt fairly high octane the lunch we had last week when Nick was talking about, I had your notes from last week. I was interested in Damian's view on this, and yours as well, Simone, about the fact that he felt we're sort of 1.5 years into a 5-year bull market. I went, oh, okay.
Absolutely.
That's enthusiastic. It's good to go.
If we talk about Epoch in a very favourable light being boring, Munro is incredibly exciting. Looking at those big structural growth trends, AI is top of the pops. But it's not just AI, it's innovative health with your obesity drugs, Alzheimer's drugs, looking at climate change, really exciting area, nuclear energy, renewables, energy efficiency.
Even blenders.
Blenders.
They're
Consumer trends.
Shark Ninja. Yeah.
Shark Ninja.
I think the word exciting and innovative, I know Ben did a walkthrough up in Collins Street maybe last year, thereabouts, and came back with that same sense that it was exciting, was energetic, and I think back to the benefit of diversification and the importance of, not having very simply all of clients' investments in that one basket. It's nice to know that we have options and, but also have clients understand that difference between, or the importance of active management and the value that active management, particularly when we have uncertain times and there's some volatility, that the benefit and the value that active management can make shouldn't be, which should be spoken about a lot. We should be talking about it. That's why we're having these discussions on the podcast. Now, I'm sure we can continue to talk for ages, but we do also want to go and grab some lunch. I've got a couple of sort of rapid fire questions for both of you before we wrap it up, and I might start with you, Simone. So one of the questions we ask a lot of our guests is, what's the best bit of advice, financial or otherwise, that you've been given in your life? What was it, and did you implement it? Did you take action on it?
2 pieces of advice. First one, and we've used this word throughout the whole discussion, and it might seem cute, but diversification. It is absolutely critical. You just can't go wrong. It is the number one rule, and that's why the advice that you give for clients, rather than trying to do it yourself, you add so much value. It's absolutely critical, whether it be across asset classes, managers, style. It is the number one rule, diversification. The very first rule of investing that I received when I was still even at high school was put away 10% of whatever you earn. And that's the first bucket that you put into, and then whatever you're left with, go for it, enjoy it. And if you exercise that discipline from your very first paycheck until you retire, you'll be in a really good position.
Yeah, so it's a nice theme that a lot of our family groups, we have the opportunity with a lot of our family groups to talk to young kids. And someone asked me the other day, what's the span of your client base? I said, well, I've got clients in their 90s and I've got clients that are a couple of weeks old, because we've got investment funds that we've set up for them and we're installment investing from day dot. And, for any of our younger clients listening, that's the message, is that start early, invest small amounts regularly, often. And
diversify. It's super boring. It's super
boring.
effective.
Yeah.
It works.
Yeah.
It definitely works. Damian, let your best bit of advice that you've received, financial or otherwise, in your life, and how did you implement it if you did?
The best bit of advice I received financially was, from my parents, and, it's hard enough to make a buck without giving it away. So they impressed on me the need to think about what I'm doing with my money. And again, to save. So I really can't top Simone's advice, but it's all old school stuff. It's don't buy rubbish, leave something in there. Make sure that there's something left over every month consistently to, build a nest egg, that sort of stuff.
Can you remember what your first investment was?
First investment, it was a stock called Sons of Gwalia.
Sounds like an album. Sounds like
I have to say,
It was a gold stock, and I had no idea what I was buying. But anyway, it went up for a while, and then it went down. But anyway, that was my first one.
Beautiful. Last question, podcast or book? Are you reading anything or listening to anything that our listeners or we should tap into, Simone?
Well, 2 favourite podcasts at the moment, All In podcast, really fascinating because they cover so many different topics, particularly on the political side, the tech side, entrepreneurship, health, fitness, absolutely everything. So find that really interesting. And I'm going to sound really boring, but the Huberman podcast.
Yeah, love it. It's good.
It's just
Andrew.
so good.
Yeah, no, it's good.
Andrew, you just need time.
I was just say you just got to
You
have.
need a bit of time. They're not short.
Jay and I get. I think we're both the same. We like a good 2-3 hour podcasts, and people go, "What do you mean? You get the longer the better."
Yeah, hence why our podcasts go for an hour and a half. Yeah. Damian, podcast, book, what are you reading at the moment? What are you listening to?
Well, I have an unhealthy obsession with US politics. So I'm devouring anything and everything on the political debate and the ebbs and flows of US politics at the moment. Largely because I just think we're in an altruistic sense. I think we're almost at a fork in the road here in terms of how the world will work as we move forward. And it worries me as a parent and as a human being. If we go the wrong way, there could be long-lasting ramifications. So I don't want to be deep or depressing, but no, I try and follow US politics daily.
What's your prediction with that situation?
Well, I really do think Biden's decision to sacrifice his ambition for the party was really quite remarkable. And I think it's all of a sudden made the race really interesting. Yeah. Whether or not she's got the gravitas to get the job done remains to be seen, and Trump is a powerful force. But it's certainly made it incredibly interesting very, very quickly.
Even, what do you think with people like Elon Musk getting on Trumpy's bandwagon? Does that change it, or is it not as real as it maybe seems?
What Elon Musk and those like him, it all reflects their self-interest. If I was to be critical of US society, it's all about the money. I wish they thought deeply or more deeply, but they don't. So the billionaires and the oligarchs, they're just out for themselves, like Musk. As brilliant as an investor and entrepreneur that he is, Elon's out for Elon.
So he's not doing it for anyone else.
So, no.
Well, I think that's a nice way to wrap it up, hey? That's a nice way to wrap it up. Simone, you might close us out with where people can actually get a hold of GSFM and all the funds and get in contact with you if there's any advisors listening, or also, Damian, how do we get a hold of, other than obviously listen to all of our podcasts and jump on YouTube? And I've noticed that you guys got a bunch of your stuff on YouTube as well.
We do, and we have our own podcast, which Damian has featured a number of times. So gsfm.com.au, our website full of materials.
I think the podcast is called GSFM Conversations Back to Basics. Is that right? Yeah, beautiful.
Correct. So heaps of material on there, including details on all the strategies that we distribute, distribution contact details for myself, for Damian, and hopefully a whole lot of really interesting material. that we may not be able to compete with Huberman, but we think it's really fascinating. We do our best.
Well, it's been insightful, been great to have you both on. Given the opportunity, we'd love to have you guys back for a round 2 at some point. We could sit and talk markets and funds and US politics probably all day, but thanks again for coming down the road to speak with us. And yeah, thanks for everything you've done for this business and the support you've provided the advisors over a number of years. So thanks again.
Thanks so much, Jay and Ben.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything.
PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.